Hey fellow REIT investors, welcome back to the channel. We're stepping into February 2026, and on the surface, it finally feels like the environment for REITs is getting friendlier. Interest rates are no longer climbing the way they used to. Financing pressure has eased, and you'd expect REIT prices to start moving in a much more straightforward way. But that's not quite what's happening. Some REITs have jumped sharply on good news. Others, including very solid blue-chip names, are still sitting there doing almost nothing. And in between, a lot of investors are asking the same question. Is this the recovery, or is it just noise? This month, I found myself doing two very different things. I bought one REIT that most people consider boring, precisely because sentiment turned down despite the fundamentals holding up. I also added a smaller, higher yield REIT, but very deliberately sized it as a satellite position, not a core bet. At the same time, I stayed away from one of the biggest positive announcements we've seen in the REIT space this year, because of the parabolic move of its prices. And there's another high-quality REIT that has been ignored for so long that it's quietly starting to interest me again. So in today's episode, I'll walk you through two Singapore-listed REITs I bought recently, and two that I'm eyeing for February. But more importantly, I'll explain why I acted on some opportunities, and why I chose to wait on others. As always, let me remind you that this video is for informational purposes only and not financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. I own some of the REITs discussed, but what works for me might not work for you. Let's get started. What I bought: Frasers Centrepoint Trust, staying disciplined amidst the noise. The first REIT I added to my portfolio this month is Frasers Centrepoint Trust, or FCT. If you followed my previous videos, you'll know I've been waiting for a better risk-reward entry point for this suburban retail giant. FCT is what I consider a default setting in the core REIT portfolio for any serious Singapore income portfolio. These are heartland malls, places like North Point City and Waterway Point, where people go for bubble tea, tuition centers, and groceries. This isn't discretionary spending, it's essential daily life. Lately, however, there's been a revival of the same noise in the news that has made some investors nervous: the Johor Bahru Singapore Rapid Transit System, or RTS, link. With the link scheduled to be operational by the end of 2026, the fear is that shoppers in the north, particularly those using FCT's crown jewel, Causeway Point, will flee across the border to Johor Bahru for cheaper groceries and dining. I've spoken about this before, and my message to investors remains the same. Don't panic. This is a story that will keep coming back to haunt the headlines, but the fundamental reality is much more robust. Most analyst reports I've read have remained positive that the impact won't be as large as feared. Why? Because the development of the Woodlands Regional Center is a massive counterweight. This area is designated as Singapore's Northern Gateway, and the influx of new residential units and office spaces like Wood Square is rapidly increasing the immediate catchment population. The population is expected to increase by 25 to 27%, to exceed 250,000 residents, providing a steady floor for tenant sales. But to be clear, this projection is over the next 10 to 15 years. Does it mean FCT will be hurt in the shorter term? I'm sure the novelty effect will push many shoppers over to JB in the initial months, but analysts and the management are not expecting anything significant over the longer term. One analyst expects the retail sales leakage to rise from the current 4% to about 5% in 2032. Furthermore, convenience is the ultimate moat for suburban retail. You might go to JB for a fancy weekend dinner, but you aren't going to take a cross-border train just to pick up a loaf of bread or drop your kids off at a tuition center. Looking at the numbers, FCT's FY 2025 results were incredibly steady. While the headline occupancy dipped slightly to 98.1%, it was due to a very specific event: the exit of Cathay Cineplexes at Causeway Point and Century Square. If you exclude that cinema space, occupancy remains at a near-perfect 99.9%. The manager has already begun re-tenanting those large boxes, which I see as an opportunity to drive higher rent per square foot by carving them into smaller units. With a gearing of 39.6% and close to 80% of debt hedged to fixed rates, FCT remains a core REIT for me. What I bought: United Hampshire US REIT, the high-yield satellite. The second REIT I added is United Hampshire US REIT, or UH REIT. This is a very different animal compared to FCT. While FCT is a core anchor, UH REIT is a satellite holding. In case you're wondering, A satellite investment is one where we accept a bit more volatility in exchange for a significantly higher yield. REIT owns grocery-anchored retail and self-storage facilities in the U.S. In a world where U.S. office REITs have struggled, REIT stands apart because its tenants are names like Walmart, Publix, and BJ's Wholesale Club. These are essential retailers that perform well regardless of the economic cycle. The financial trend for REIT has been quietly impressive. In 1H 2025, they reported a DPU of 2.09 US cents, up 4% year-on-year. This was followed by a 3Q 2025 update where distributable income rose 15.5% year-on-year to about $7 million. This wasn't just organic growth, it was supported by new leases and, importantly, lower interest costs as the interest rate environment began to ease. What makes REIT attractive right now is the stability of its business and its high yield. With a dividend yield of over 8%, it provides a massive income boost to my portfolio, while not increasing the overall risks as much. Of course, we must be disciplined. It is a smaller REIT with a market cap of around $300 million, and being USD denominated means there is currency risk. This is why I right-size my position. I don't let a satellite holding dominate my risk profile, but I'm happy to let it pay me a high single-digit yield while the underlying assets are performing at 97.2% committed occupancy. Quick pause here. If you're finding this helpful, do give the video a like. It really helps me and the channel reach more long-term investors like you. And if you want the breakdowns written in a no-nonsense style, I've put them up on my website, thedividenduncle.com. You can check it out after the video. Alright, let's move on to what I'm eyeing in February 2026. Digital Core REIT, the December 2026 reset. Moving on to what I'm eyeing, let's talk about Digital Core REIT. This counter has been the talk of the town recently following a major announcement in early January 26. They've reached a 10-year agreement with an investment-grade global cloud service provider to occupy their entire facility at 8217 Linton Hall Road in Virginia. This is a massive fundamental shift. This agreement is expected to generate approximately $13.3 million in annualized net property income, or NPI, for the REIT's 90% share. That represents a 35% increase relative to the previous net rent. Once this lease commences, the overall portfolio occupancy will skyrocket from 81% to 98%, and the weighted average lease expiration, or WALE, will extend from 4.7 years to 5.7 years. At its current price of around 54 US cents, Digital Core REIT offers a very attractive dividend yield of above 7%. It's trading at a significant discount to its net asset value, or NAV, which sits around 78 US cents. For a data center play, that is a substantial margin of safety. However, as a disciplined investor, I'm not chasing the recent 10% price spike. Why? Because the lease doesn't commence until December 1, 2026. This means the market is pricing in cash flow that won't show up in the distributions for nearly another year. Furthermore, the REIT is investing $40 million in capital expenditure for this redevelopment. While I love the development, I'm waiting for the initial excitement to cool down. If the price consolidates or if we see a broader market pullback, I'll be looking to accumulate. What I'm eyeing: Mapletree Industrial Trust, the quality laggard. Finally, the second REIT on my watch list is Mapletree Industrial Trust, or MIT. MIT is the opposite of Digital Core right now. It hasn't had a big headline moment, and as a result, the price has been somewhat stagnant. For the past 1 year, MIT's share price has gone nowhere, down about 5%. This is not helped by MIT's results for 1H FY 2026, which were a bit tepid, with DPU down about 5.6% year-on-year, largely due to exchange rate headwinds and higher borrowing costs from previous quarters. But this underperformance is exactly what has kept the yield attractive. At current levels, MIT offers a dividend yield of approximately 6.3%, which is a rare level for a blue-chip REIT. When you look deeper, MIT is actually in a position of strength. Their gearing is a healthy 37.3%, and their interest coverage ratio is a robust 3.9 times. They've pivoted a portion of their data center portfolio to Singapore and Japan, while maintaining a strong base of high-spec industrial assets in Singapore. Their cost of debt is stable at around 3%, and they have a BBB+ credit rating. The market is currently ignoring MIT because of the challenges faced by some of its US data centers. But for a long-term dividend investor like this uncle, I view the current poor investor sentiments as an opportunity to steadily invest in a Mapletree-sponsored REIT yielding more than 6%, with half its assets in the stable Singapore's industrial sector, as a potential quality laggard play. I'm continuing to eye an entry point in February if the price stays suppressed. Personally, I hope to capture the eventual recovery in MIT. The dividend uncle's take: discipline over hype. So let me wrap this up in one takeaway. This month, my two buys reflect two different roles in my portfolio. FCT is a core stability buy. It's the kind of REIT I want to own more of when the market briefly gets nervous, even though the underlying business remains resilient. The Cathay vacancy headline may have spooked some investors, but the details tell you the demand for suburban retail space is still strong. REIT is a satellite income buy. Its improving distributable income and DPU trend are supported by leasing and lower interest costs, but it remains a smaller USD-exposed REIT that must be sized appropriately. For my two eyeing names, the contrast is intentional. Digital Core REIT has delivered a very strong leasing development that improves future occupancy, WALE and credit quality, but the key rent uplift begins in December 2026, which means I'm refusing to chase the first burst of excitement. MIT has no fireworks, but it's exactly the kind of high-quality REIT that can surprise people when pessimism lingers too long and the macro environment slowly turns less hostile. And the one core rule behind everything you heard today is this: I'm not trying to predict the next 30 days. I'm trying to build an income portfolio where the decisions I make during boring months look obvious in hindsight. Let me know in the comments, are you buying any of these four REITs? And for Digital Core REIT specifically, do you think the market is pricing the December 2026 cash flow correctly, or do you think we'll see another chance to accumulate lower? If you found this update useful, do give the video a like. It helps the channel reach more fellow income investors, and it tells YouTube that this kind of calm, long-term investing content still matters. As always, stay safe, stay invested, and I'll see you in the next one.